What is the interest rate that is going to mitigate the impact of $60 oil to 100? What is that interest rate? Do we take them to 10%, to 15%? The whole thing is ridiculous. This is an exciting market. It's an exuberant market, but is it a rational market? The equity investors are telling you that the S&P 500 is no longer a risky asset. It's become a riskless asset. And I'm not quite at the stage of my life where I'm ready to throw Harry Markowitz's CAPM model into the waste paper bin.
I'm delighted to welcome back to the show David Rosenberg, president of Rosenberg Research Associates, Canada's most famous economist. And we'll be talking about Canada today, including what happened with the latest GDP reports, and we'll be getting David's outlook for what's next at the FOMC meeting that we can expect this week. Kevin Warsh's first appearance at the FOMC, what to expect from current market sentiment, and what's next after the Iran deal has been reached. Welcome back to the show, David. Good to see you.
Great to be back on with you, David.
We'll also be going over some of the latest economic numbers, inflation hotter than expected, jobs numbers beating expectations for both non-farm payrolls and jobless claims. We'll talk about that. First, Trump's deal with Iran today. JD Vance says a lot of Iran deals still need to be figured out, the details that is, but the U.S. has all the cards, were his words verbatim. The markets are euphoric. The Dow jumped about 600 points intraday, and the Nasdaq is up 3%. Will this wipe out any bullish sentiment for you in the intermediate term? Does this make a fundamental difference to you, David? Let's start here.
Well, in terms of the deal with Iran, I mean, there's no deal. There's a memorandum of understanding, so it's a deal to do a deal, and there's 60 days of negotiations, and let's just see how things cook. I mean, we've sort of been down this road before, David. So
that's right. So you think markets are getting ahead of themselves right now?
No, they're reacting to the new news, I suppose, which is now the Strait of Hormuz reportedly will be reopened. So you could argue at the margin that's a pretty big deal. But, what did you really get out of it today? A modest decline in bond yields. The stock market was just having the extension from what happened on Friday. So it's hard to really split out how much of that is this memorandum in terms of the impact on the markets. I mean, what did oil prices go down, like the grand total of $4? So I'd say that it's an appropriate response by the markets. I think I would refer to it as a cautiously optimistic response. We've been down this road before, and we'll see where it takes us. But, the reality is that we've known for the past probably 2 months that Donald Trump wanted to walk on that exit ramp. So the big question is going to be that even if there's a deal, what's that deal going to look like? But right now, just the thought that the Strait is going to reopen, and that's enough to cause a further relief rally in the markets, but not much more than that.
Would it have a fundamental impact on the U.S. economy in particular if the Strait is closed or open at this point?
Well, I think that if it closes, then we're going to get a big negative response. If we were to go back to where we were in March when the military confrontation was back in vogue, that would elicit a big risk-off trade. It's not likely going to happen because the midterms are staring the Republicans in the face, and Donald Trump really wants to get this deal done badly. Which makes me wonder what sort of deal it's going to be. If we have the kumbaya moment and, we actually get a deal signed, remember it's still a couple of months away. I'm not going to say that that's going to take the oil price down to pre-war levels. There's going to be some obstacles to that, but you'll get some more relief on the energy side. That will take some of the pressure off the U.S. consumer and profit margins. So that'll be viewed positively. But I think right now, based on what's priced in, the bigger tail risk is really if things go awry. That's the bigger risk than things going right, because the markets have already been moving in that direction ever since Trump made it overt that the exit was the only way out for him, notwithstanding some of his bellicose statements. Everybody knows he wants to walk on the exit ramp. So the tail risks really are more towards what if that doesn't happen.
Well, bond yields have come down a little bit slightly. They've slid slightly on the day. The 10-year still near 4.5%, though, David. Is this the danger zone, as HSBC will call it? Any further than this, and we're going to see further stress on the rest of the markets and the economy alike?
Well, I would say, we're pretty well at 4.5. The stock market is done just fine. I think that if you were to go back and test 5%, which is where we were at the peak in the fall of 2023, so that's another 50 basis points away, 60 basis points away, that could cause some angst in the equity market, alongside if the long bond were to get to a 5.25%, 5.5% range. It hasn't been able to really break above 5%. But you get another 50 basis points or higher up in treasury yields. And I think that's going to be a pretty big obstacle for the risk on trade.
Well, do you think that the bond market is signaling higher inflation that's going to be sticky? The fact that it came down today, maybe the bond market's reacting to what's happening in Iran, and that can change inflation expectations. What do you think?
No, not a bit. Not a
Okay.
bit. In fact, when you look at the 10-year TIPS break-evens, they're at 2.3%. They haven't moved out of the range, despite all these multiple shocks. You've got the 5-year forwards at 2.2. There's been despite all the rhetoric out of the Fed and despite all the rhetoric out of Wall Street economists and strategists about the big inflation, this has been a move in real rates, and that could be partly reflecting fiscal policy. It could be reflecting the demands on capital coming from, the borrowing surge to fund the AI boom. But it's been driven by real interest rates on inflation expectations. You would have thought actually today would have been a much bigger down day in treasury yields, and it was very modest, despite what oil prices did. And so it's the real interest rate that's proven to be very sticky. Inflation expectations haven't really been much of a factor.
Before we continue with the video, let's take a quick look at a platform designed for investors who want more control over how they trade. Our sponsor today, Webull Canada, offers $0 commissions on US and Canadian stocks and ETFs, along with a range of tools built for both newer and more experienced investors. One thing that stands out is the promotion right now that allows you to access 3 months of free real-time market data upon deposit, including level 2 quotes and options data, which are often paid features on other platforms. Webull also provides a full trading interface with technical indicators, charting tools, and customizable alerts. Whether you're using mobile or desktop, these are all available. If you want to test strategies first, there's also a paper trading feature that lets you practice without using real money. And right now, they're offering a welcome bonus of up to $250 in cash back for eligible users. That's $250 that you could use to invest more, build your portfolio, or get started sooner. You can go to the link in the description down below or scan the QR code here to learn more and get started. What do you think the Fed is going to do in the next coming months? Let's evaluate inflation and the jobs market, two things they look at. 4.2% harder than expected. That's headline CPI driven mostly by gasoline and oil prices. On the labor side, non-farm payrolls beat expectations by quite a bit, but so did initial jobless claims from last week. The unemployment rate is also up slightly. What is your take on the current situation of the labor market and inflation?
All right, well, let's tackle the inflation first. Last I saw, the core CPI in May was plus 0.2, and the consensus was plus 0.3. So the core actually came in light. And when you're taking a look at Kevin Warsh's favorite metric, which was it's the PC deflator, the trim mean version, which removes the most extreme movements in the items in the index, you're running about 2.3%. That's his favorite metric. I imagine he'll talk about that quite a bit at the podium. Whether or not the Fed replaces that as their metric, well, we don't know that, but that's his favorite metric, and it's running just a little bit above target. What we do at Rosenberg Research is we have our own core number, which is the core CPI, but we adjust for the things that reside right next to the oil price, like airfares and like delivery services and like utilities. And when you adjust the CPI for those metrics, it's running at 1.8% year over year. So when you exclude, the energy components and what resides next to what is energy, I mean, airfares are only up what they're up 30 or 40% year over year in delivery services because of what's happened with fuel prices. So I think you almost got to count that in the bucket. Because if oil prices stabilize or come down, airfares and delivery services and utility costs in the CPI are going to come down too. So you adjust for those, and it's not data mining, it's analysis. Inflation's already running below target. I don't see, so someone's got to explain to me, where's the inflation story outside of, say, energy? And you can talk about commodities, but the commodity story's been around for quite a while. The commodity story was around a few months ago when the 10-year Treasury note yield was heading back below 4%. The industrial commodity story, which is tied to AI and data center construction, it's not a new story. Going from $60 a barrel to $100 on oil, well, that's the big story. But now oil prices look set to level off, potentially go down. They won't go down to pre-war levels, I don't think. But the inflation from energy has been broken. Now I'm taking a look at this situation, and the question really is, has it seeped into wages? The answer is no. And we can talk about the tight labor market all we want, and the, nominal wage growth is slowing. I don't know how you can square that circle. How is the labor market tight and nominal wage growth slowing down? That is mutually inconsistent. You are not seeing the price increase from energy seep into wages. In fact, real wages have contracted now 3 months in a row. I already mentioned that the energy shock has not been transmitted to market-based inflation expectations, and it's not transmitted into wages. And the link between commodities and inflation is actually very loose, because what dominates inflation is more services, because that is what comprises most of the U.S. economy. Now, the services that are inflating are the stuff that is most related to what's happening on the energy side. You cure the energy side, and the things I mentioned, like delivery services and airfares and the like, will start moving down. They'll be deflating. So I don't see where the inflation story is. I think it's just, bonds sell off, and analysts believe they got to fit the narrative to the price action, just as they do in the stock market. And as for the labor market, look, yes, we got better than expected numbers in May. They're going to get revised. We don't know in which direction. But these numbers move around a lot month to month. You can trade around the non-farm payroll numbers, sure. But the best snapshot you get of the labor market is the broad trend. Where's the year-over-year growth in non-farm payrolls, even with the May bounce? Plus 0.3%. Plus 0.3. And where's the year-over-year trend in the companion household survey? Negative 0.3. So we have flat employment growth. The only reason why the unemployment rate hasn't ratcheted up is because we don't have any growth in the labor force. So we have a totally sclerotic, stagnant labor market, and everybody thinks that it's red hot. What amazes me is everybody thinks, including folks of the Fed, that this is a tight labor market because they are anally focused on the U3 unemployment rate. They have to answer the question as to why then is nominal wage growth decelerating as much as it has. Roughly 3% year over year now. It was closer to 4% a year ago. Why is that happening in a tight labor market? And I'll tell you why. Because the labor market is not as tight as it appears on the surface.
Do you think the wages are lagging, though? Do you think that with 172,000 jobs added in May, that's going to catch up eventually?
Do you really believe the economy added 172,000 jobs in May? Do you believe that number? Like, are you telling me that you don't expect that number is going to get revised?
I wonder how much of
Numbers have
that is
been
temporary
revised
workers. But
100% of the time in the past year, and about 85% of the time they've been revised lower. So, I write about the jobs numbers. They come out monthly. I think I've covered 500 of them. But as I said before, to base your judgment on one number in the context of a trend that is roughly zero, no, I focus on the trend. I don't focus on the last data point. And so, no, I don't, are wages a lagging indicator? Yes, they are. But so is employment a lagging indicator. But there's the broader picture, and the year-over-year trend is showing you that employment growth is flat. That's just a fact. We could argue whether wages are a lagging indicator, but all I'm saying is that if the truth is always in the price, as it should be, why is the price of labor decelerating if the labor market is actually tight? Now, that's not a question for anybody else except for if I was sitting with the media in front of Kevin Morris on Wednesday, I would ask that question. Everybody at the Fed thinks labor market's just in dandy shape and the labor market's tight. Why is wage growth slowing? Why are wages? Because, you can argue inflation is lagging too. Wages are lagging, inflation is lagging, the labor market is lagging indicator, all lagging indicators at best coincident. But just tell me exactly why there's this concern about inflation when wages are lagging behind. You see what happens? What happens is that when a supply shock hits the labor market and leads to a contraction in real work-based income, you then get negative real consumer spending. And the only reason why consumer spending hasn't been negative is because the high-end consumer is spending the equity wealth effect, the equity gains. The savings rate has been melting. It's gone from 5% to almost 3%. And you're seeing low-end, stressed out, tapping credit cards like they never have before. It's been incredible what's been happening with credit cards. That's a sign of stress, but that's been helping them sustain themselves. Because even spending on groceries is spending. The high end is spending a lot more than just on groceries. But the thing is that if it weren't for that drop in the savings rate, which I would argue is the most behavioral aggregate of the national accounts, that decision at the margin as to how much you're going to save or spend after that last after-tax dollar that you earn, it's so important. If the savings rate hadn't declined the way it has in the past year, real consumer spending would be negative 1%. We would be talking about a consumer recession. Do you know what I'm saying? I'm saying that if consumer spending had matched the trend in real disposable income, because real disposable income is running negative 1% year over year. Think about that. Imagine if the roles were reversed and incomes were up 1% and consumer spending was down 1%. We'd be talking about a recession. But because we're so narcissistic, and we basically only always talk about the spending side of the economy, and we don't talk about the income side. There's about a 2 percentage point gap between incomes and spending. Real disposable income in the United States, despite this red-hot labor market, is running negative 1%. I tell that to my clients. They don't believe it. I have to show them the data. That if you look at the income side of the balance sheet, the U.S. consumer is in a recession right now. But we measure recessions on the spending side, not the income side. So just another bifurcation divergence in this K-shaped economy. And the K-shaped economy is not just between high end and low end. It's ubiquitous.
Well, if someone's spending money, someone has to earn money. So I wonder who's actually benefiting from people spending money.
Or you borrow it. Or you borrow it. Or you reduce, or you reduce your stock of savings to fund your consumption. There's different ways that you could do it.
Savings rate has been falling down.
Precipitously.
The ECB raised their interest rates last week for the first time in, I believe, 3 years. Yeah, nearly 3 years on Thursday. Now, there's two ways to look at this. One, that's a policy mistake, or number two, they're right in nipping inflation in the bud before it becomes a systemic problem outside of just gasoline. Which is it?
This is the same ECB that raised rates in the summer of 2008.
I remember that. I was just going to ask you about that.
But why? Because we had an oil shock. Oil went to $148 a barrel. So they raised interest rates. By the way, the Fed at that meeting moved to a tightening bias. They didn't pull the trigger, but said they were going to. I think it was a policy mistake because we're dealing with a supply shock with no reverberations. So you're going to layer a supply shock and an oil price shock with an interest rate shock. Well done. No, I think the European economy is too weak. I don't think inflation is a big problem. They're going to look back on this and not say, what are they going to do? Are they going to take back that rate hike if this memorandum turns into a deal and oil prices reverse most of what they did? I just don't understand the tempestuousness, the impatience. This was a level shift. This was a level shift in prices over a short time period because of energy. How is a central bank? I'm not picking on the ECB. We could pick on the Fed. And Tiff Macklem, he sounded less hawkish than he did 6 weeks ago. But what's this thing about basically, are these central banks going to drill for oil? What is the interest rate? What is the interest rate that is going to mitigate the impact of $60 oil to 100? What is that interest rate? Do we take them to 10%, to 15%? The whole thing is ridiculous. What the central banks should do is assess whether or not it's feeding into wages. And that was the problem with transitory that wasn't transitory, because back in 2021, 2022, we had a red hot labor market where the younger cohorts of the labor market were job hopping like there was no tomorrow, and the government was paying you not to work with those extended pandemic jobless benefits. So the corporate sector had to pony up big time as the economy reopened to bring you back into the workforce.
When you look around
the point is, yes, the ECB made a mistake. And I think that even Tiff Macklem made a mistake, but even hinting that we could raise rates, like basically, and I'm very surprised because I think he's a terrific economist. Like, how could you say that without knowing how this is going to affect the labor market? And I'm talking about wages in Canada too. Nominal wage growth is cooling off. And so as a central banker, you can't be caught talking about, well, May did this and April did that, because the wage number tells you, because it's the price, it's telling you how the supply and demand curves are moving in tandem in the labor market. That's what it's telling you. So I would have suggested that even Tiff Macklem, I would have just stayed neutral. I wouldn't even hinted at a rate hike, and I'd say that the people at the Fed, I swear, I don't know where they're coming from. I think that because the Fed's run by human beings and not robots, they're still caught in that trap of fighting the last war. They feel so shamed, and their credibility lost because of what happened in 2021 and 2022. Went from 0% inflation to 9% inflation, and it's collective shame. I think if we didn't have that experience, they wouldn't be sounding as hawkish as they are right now. But the evidence is in. The evidence is in. You talked about CPI before. That was not a hot number. The headline was hot for obvious reasons. Core was 0.2. Hello? Core was 0.2. The wage numbers are cooling off. 10-year inflation break-evens are 2.3, and the 5-year forwards are 2.2. So I guess as a central banker, you're paid to not let your guard down, and I imagine that's what they're doing. The ECB, I think, just should have. They wanted to continue to talk tough like the Fed is, but I think pulling the trigger was a mistake. And if they double down on that, it'll be a mistake twice as big as to what they already did. It was unnecessary.
Speaking of the Bank of Canada, so you think Tiff Macklem should stay neutral. What should, generally speaking, a central bank do when we had 2 quarters of consecutive GDP decline, but at the same time rising inflation fears? They're contradictory concepts when you think about it. How does a central bank respond in that environment?
Look, I'm trying to explain it. There are no rising inflation fears. Maybe there is in the media. It's not. There's no inflation fears in the market. Most of this move in bond yields has been real interest rate driven. It's not been because of inflation expectations. I know that, strategists and economists, for some reason, they're yearning to have inflation. I don't quite get it.
So you think the bank should lower rates?
Well, I think the Fed. Look, the Bank of Canada is already at 2.25. So how much further are they going to go? I mean, the economy would really have to puke for them to cut rates. To raise rates, though, I just don't see the case. The Fed has more room to cut interest rates. Of course, they're coming at it from a much higher level. And I think the economy is going to be far weaker in the second half of the year. The fiscal fun and games underpinning the consumer, the stepped up income tax refunds, that's in the review mirror. The stimulus from the World Cup, that's in the review mirror. You're going to find the second half of the year in the United States, there's going to be a spending vacuum. And I think that there'll be a mean reversion of consumer spending on incomes, which are running negative. Nobody's priced for that. In the Canadian context, yeah, you can make the case what central bank doesn't cut rates with back-to-back negative quarters, but the negative quarters were negligible. And the second quarter looks like we're going to get at least a little bit of a rebound. But I take your point. Again, what's more important for a central bank is not what GDP growth is doing. It's what is GDP growth, when GDP is aggregate demand, doing relative to aggregate supply. And don't forget, GDP is about spending. It's about demand. But in Canada, when you consider that we have no productivity growth and we have really no population growth, you can argue that the supply side of the economy is about as weak as the demand side. So the important thing for the central bank is the output gap. What is the degree of excess capacity, excess supply, excess demand at any moment in time? And that's what really amazes me is why would Tiff Macklem even sound remotely hawkish, unless he just wants to show that I'm not letting my guard down. I'm not going to let inflation get out of control. I mean, he didn't sound dovish at the last meeting. He sounded actually just less hawkish than the meeting before. But he came out and said that the Canadian economy is still operating under a state of excess supply. Well, you don't need to have an economics degree to know that means that's going to put downward pressure on inflation. And inflation is already a target. So I don't think the bank's going to be doing something for some time. But if you're going to ask me right now, and this is where the trade is, because the markets are priced for the Bank of Canada still hike interest rates, I think the next move will be to cut, not to hike. At a minimum, just stay on hold indefinitely. And I think that, look, the bottom line is that the same money market in the United States that not long ago was priced for 2 rate cuts is now priced for a rate hike by the end of the year. I am still in the rate cut camp. I will take the other side of the bet that the traders in the futures pits have put on as far as Fed funds futures are concerned. I think the Fed will be making the next move a cut, and it has nothing to do with Kevin Morris having to kowtow to President Trump. That's not going to happen. It's going to be the data. And I think people will be surprised where inflation is by year end. And I think they'll be surprised at how weak the U.S. economy is by year end as well. People, may make up their minds on the economy based on what the stock market is doing. Well, GDP and S&P aren't the same thing. The Fed's not going to do anything because of the stock market, but they will because of the economy. And I think the economy is going to flatten in the second half of the year.
When you say that Canada's in a supply surplus, are we talking about housing or are we talking about something else here?
We're just talking about, generally speaking, the overall, just the overall economy, just looking at where the state of supply is overall. It's not housing, absolutely. House prices are deflating. And now in the United States, they're close to deflating. We know the situation in Canadian residential real estate. But it's fairly endemic, right? It's also evident in the weak trend in consumer spending. What do you do as a retailer when consumers become more frugal? You cut your prices or you hold back on price increases. It's really I can't see anything in Canada. Of course, we don't have AI in Canada. The government's trying to do that, but that aside, I can't see. Look at commercial construction, residential construction, consumer spending. The global economy is not doing well, and Canada, is really a torque export-wise. I can't look anywhere under the rug on the Canadian economy and find any source of vitality whatsoever. If this was the aggregate demand we were seeing, the GDP, if we were seeing this GDP a few years ago, when we had booming population growth, you'd be talking about, because that figures into the supply side, we'd be talking about outright deflation in Canada. But what I'm saying is that aggregate supply is anemic and aggregate demand is anemic. When the Bank of Canada tells you that we're in an output gap or excess supply or demand deficiency, it just means that as weak as the supply curve is in Canada, the demand curve is even weaker. So that's why you always have to take a look when you're talking about inflation, about the interaction of those two curves. For anything, how can you forecast anything? any price without supply and demand. Inflation is the aggregate price level of the overall economy. The fact that core is at 2%, I'm not going to say that Tiff Macklem and his crew have to, do a bunch of high fives in a victory lap. They should be feeling good about that. But for whatever reason, at the margin still, and that's why the markets are priced for Bank of Canada tightening. Tiff Macklem did nothing to cause the markets to fully price that out.
So how would you explain this, the growth prospects of Canada to somebody living in Canada or just somebody observing the Canadian economy? I'll add a few facts to what you've said earlier. The TSX has been outperforming the S&P for most of this year, 2026, and late last year. On top of that, Pierre Poilievre, opposition leader, has blamed the Liberals for the 2 quarters of contracting GDP. Mark Carney calls it a quote-unquote settling in period for the Canadian economy. The Bank of Canada has not officially designated this as a recession. Like you said earlier, under the hood, you're not seeing signs of growth. But at the same time, there's been new deals made with China on the EV front, and we've already talked about the Bank of Canada. So what actually is happening?
Well, I mean, that's just nibbling around the edges. What we have is this. We have the ongoing tariff-related uncertainty. Now we have Donald Trump saying he might not even renegotiate the USMCA. That could cause, capital spending plans to be shelved. We have a housing market where even with the price declines, affordability is still quite stretched. And the biggest problem is probably the debt bubble on Canadian household balance sheets. I don't know how we did it. We avoided a disaster scenario in terms of a major default cycle. It didn't happen. The banks reserved for that, and they've unleashed those reserves. And of course, the Canadian banks are doing very well because that shows up in their bottom line. It looks like a lot of the financial institutions worked with the stressed out Canadian borrower, worked out their payment schedules. Yeah, but when you're taking a look at Canadian household debt to income ratios, they're like 40 percentage points higher than they were at the peak of the U.S. credit bubble back in 2007 when I was toiling for Mother Merrill. We still, nobody talks about it. We have a crisis on Canadian consumer balance sheets. The debt ratio in this country, the debt problem is not in the business sector and it's not in the government sector, although we like to bellyache about the public sector, but it's household balance sheets. And that's why even with lower interest rates, debt service ratio, what debt service takes out of personal income, is still at the high end of the historical range, even with interest rates as low as they are. Why is that? Well, because we're compounding those lower rates, indeed, off a huge debt bubble on the household balance sheet. That is a prolonged constraint on consumer spending in Canada, which is 60% of GDP.
Would this have happened, this debt bubble and issue that you talked about, independent of the U.S. tariffs, which you brought up? The media and the government alike are blaming the Americans for the current situation in Canada. Are they right to do so?
Well, I guess that you can argue, the European economy, I would say the Canadian economy is flat. I'd say the European economy is flat. Tariffs have certainly been a big part of it, but in some sense, we were protected by the USMCA. A lot of our products, weren't subject to the Trump tariffs, but it just creates this uncertainty. The impact is probably more on capital spending than it is, say, on exports directly. So no, would I blame the United States? Not entirely. I think Donald Trump, you could argue, has been positive in the sense that he's just generated this consumerism, or he's tried to, and consumers in the States buy a lot of Canadian products. So I wouldn't put the blame in the White House. It's very difficult to accept responsibility. How did Canadian household balance sheets get this overextended? Did Donald Trump let that happen? Or was it Donald Trump's decision in the last Canadian federal budget not to cut taxes. Donald Trump cut taxes. Canada doesn't cut taxes, except marginally. I think that, the one thing I didn't bring up is that I think it was absolutely criminal that the Canadian federal government didn't respond to a huge negative shock for Canada, which was when in 2018, Donald Trump cut the top marginal corporate rate in the US from 35% down to 21%. We're stuck at like 26%, including the provincial abatements. Canada has to stay. So, whose fault is that? You see, in Canada, and especially in the Liberal Party of Canada, you can't run a campaign saying I'm going to cut corporate tax rates, the fat cats on Bay Street, even though those fat cats, the corporate sector creates 2/3 of the jobs in this country. But how come nobody ever asked the question, why did Canada not respond to what was an exogenous shock, which was a monumental decline in the U.S. top marginal corporate tax rate? So I would say that was an invitation. Canada's lack of a response was an invitation for the corporate sector to relocate into the United States, because capital will flow to where tax rates are the lowest, and the U.S. resides right next door. Again, nobody talks about these, right? Yeah, we'll blame Trump, we'll blame the U.S., and we don't look in our own backyard. We created, that's one of the reasons why productivity is so weak in this country, and why capital formation has been stagnant for a decade.
I'll make one final point.
Sorry?
I'll make one final point on Canada, and then we'll go back to the markets and close off there. So initially, I thought maybe the lower GDP numbers were because of the lower population. Canada's population overall has been declining for the second year in a row now, David. But then I looked at GDP per capita, and that's been flat all year. So I don't think that's it.
And in the U.S., the U.S. has no population growth either.
Okay, so turning back to markets, and we'll close off here. The expectations for bond yields that you have, will we continue to see gradual increases in the long end of the curve above 4.5%?
That's not my expectation. I think yields have peaked. I think they will come down. I think they'll come down most of the front end of the yield curve, so it'll steepen, because I think that those rate hike expectations are going to come out. I think in the U.S. we'll revert back to those 2 rate cut expectations. Remember, the 2-year note has gone up like 60, 70 basis points since the war started. So I like the bond market. My 3 favorite bond markets. I like Canada. I love the front end. I like the front end in the United States too. And I got to tell you, the long bond yield at 5%. The last trade I did in the Rosie model portfolio was I stuck in 5% into the U.S. long bond. Nobody wants to own it. I like to own what's out of favor, but a 5% nominal yield on the long bond and 2.75% real yield, the chances of you historically not making money in the bond market at these levels is zero. I want to make money. That 2.75% real yield, that's like the S&P trading with a 15 multiple. Okay? That's how much bad news there is in the bond market. And I could tell you, if the P multiple ever got to 15 in the S&P, I'd be lining up to buy. Okay? No, I think that rates are going to come down. Curve will steepen. So I like Canada, I like the US, and I like the Australian curve. I like Australian bonds because they started raising rates early and they're getting near the end of their hiking cycle. So I like those 3 bond markets globally.
Is a steepening yield curve positive for the equities markets, especially the U.S.?
Normally I would say yes, except this is a very abnormal market. A very abnormal market. I think that to restore a positive equity risk premium in the S&P 500 of any magnitude, you probably have to see the 10-year note get down towards 3%. That's how crazy it is. I mean, the equity risk premium in the United States, depending on how you want to measure it, is flat to negative. This is an exciting market. It's an exuberant market. But is it a rational market? I'm not so sure. When the equity risk premium is flat or negative, the equity investors are telling you that the S&P 500 is no longer a risky asset. It's become a riskless asset. And I'm not quite at the stage of my life where I'm ready to throw Harry Markowitz's CAPM model into the waste paper bin.
Okay, well, excellent. Thank you very much for your updated analysis. Tell us where we can find your work, David.
Well, you can just basically go on the internet and just Google Rosenberg Research, or go to information at rosenbergresearch.com. It'll take you right to the front page, and you can sign on for a free trial. My direct email, if you want to contact me directly, I won't give you my phone number. That's a little too much information. But my email is drosenberg at rosenbergresearch.com. And I'd be happy to field anybody's questions that either come through you, David, or if people want to get in touch with me personally. I don't sleep very much, so I'll be happy to answer all your emails. So send them in.
Please do get some rest so you can give us more analysis. We appreciate it. Thank you very much, and do reach out to David. I'll put his email down below and the links to his website down below as well, so check out Rosenberg Research. Thank you again, David. Speak again soon. Take care.
All the best. Take care.
Thank you for watching. Don't forget to like, subscribe.